Markets around the world continue higher into all-time highs as earnings season kicks into gear. The S&P 500 experienced yet another day of gains. However, the spotlight shifted to small caps following their impressive 2% surge. So in today's video, we're going to dive into the implications of this small cap rally for the broader market and what it means for market breadth, while also addressing the labor market. Corporate layoffs are accelerating, and today we have to ask the question, how durable is America's labor market? Hello everybody, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell. Let's get into it. Another day, another new all-time high with financials and healthcare leading the charge higher. Although PayPal right here, the only stock that didn't perform in the financial sector, we'll talk about them a little later. And we've seen industrials perform really well over the last week. This is a sector that has flown completely under the radar as all the spotlight has been on semiconductors and technology, which put out a green day all things considered, but was really held back by Microsoft, especially in early trade. But all in all, green across the board, another new high for the S&P 500. And we got the latest weekend poll, the sentiment survey. 58% of you guys are bullish, 42% of you guys are bearish. And these numbers were flipped last week. 60% of you were bearish. And for the first 2 to 3 days of the week, it seemed like the bears were in control. And then we had that massive starting Wednesday afternoon, and sentiment has flipped, and we'll see who takes the cake this week. But for the most part, a lot of you are bullish. Now, looking at the majors as a whole and small caps, it was all small caps. The talk of the town was small caps. Everything performed well on small caps. IWM up 2.14% for the day. Mid caps too. The S&P 500 and Nasdaq as a whole did put up green days though. And again, you look at this right here, and that's not a bad day for the S&P 500. You take those gains any day of the week. Now, earnings season is kicking off gear, guys. I mean, tomorrow is when it really starts. Before open, we have Verizon, 3M, GE, Raytheon, Johnson & Johnson, Halliburton, and then after close, we have Netflix, Intuitive Surgical, Texas Instruments. We're really kicking earnings into gear. And then on Wednesday, more big names, ASML, Tesla, Intel, Visa on Thursday. But here are the results so far for earnings. And as you can see, the sector that's reported the most has been financials. Only 42% have beat earnings expectations. 58% have beat sales, but only 25% have beat EPS. Only about 13% of S&P 500 companies have reported earnings. That's going to change significantly this week. But all things considered, we only have a 56% EPS beat. 60% of companies are beating sales, but only 37% so far have beat on EPS and sales. And looking at now, diving into the sector performance for the day. Now, we do know that the best performing stocks for the day were like small and mid caps, and that's why we see like stuff like regional banks at the top, home builders, industrials. These generally tend to be in the mid cap, smaller cap range. A lot of rate sensitive names performing really well today, but we also did see, semiconductors put out a good day. So too did technology, healthcare as well. And the losers were discretionary, staples, utilities. Now, let's get back into earnings and talk about some stats. Jan to Feb has historically been the weakest period for guidance, as you can see right here, especially during the earnings season. And here is the revision to the consensus estimates for the fourth quarter of 2023. Now, you can see here at the S&P 500 as a whole has actually revised to the upside 0.3%. Again, this is according to BOFA and FactSet. The majority of this probably comes from financials as well as technology. What's leading the charge to the downside is energy, materials, and communication services. But do take into consideration that communication services were priced for something like 42% growth for the quarter to report something like that. So this isn't anything to be worried about. Now, here is the revisions according to the previous trend, and this is the fourth quarter 2023. We are tracking well below the average for the fourth quarter 2023. For 2024, we are tracking above average, but all in all, normally what companies do is they give you a number, revise down, and when they beat, the stock goes up. And you can see this is exactly what happens in history. That being said, this earnings season, companies are getting punished for missing. There's no rewards for beats, but bigger reactions to misses. And you can see here that if you beat on both, the stock hasn't really moved, although we're only just getting started into the earnings season, and the volatile stocks are reporting over the next 2 weeks. But if you miss on both, you're getting absolutely sold off between 4 and 6% over the next week. Now, here is some earnings expectations to look forward to in the future. Now, for 2024, we are expected to report 244 earnings per share, but for 2025, we can actually expect a 10% growth again, 272. 2026, we can expect 9%, and then we can actually expect 9% again from 26 to 27, and then from 27 to 28, it's another 10%. So over the next 1, 2, 3, 4, 5 years in the S&P 500, we are actually looking at anywhere from 9 to 10% growth on an annualized basis. That's exactly what you want to see if you want to be invested into the market. And if you go ahead and actually look at PE ratios on a 2028 basis, I was looking at the mega cap, the Magnificent Seven. On 2026 earnings, they trade on like a 20x PE, and I'm sure the market as a whole on 2028 earnings probably trades at like a 10 or maybe even an 11. So if you do look, 5 years out into the future and optimize your returns for 5-10 years plus, the market right now does look really, really cheap. Let's switch gears and actually talk about the macro. And this is something a lot of people are quoting. This is the LEI, the Conference Board Leading Indicator, and it has been in this deep contraction territory below the -5 mark. Normally, below the -5 mark is a recession signal. Now, we are trending up towards that, but we have been in this deep contraction territory for most of the year, and we haven't gotten our recession yet. And this is a worrying sign for economists. Now, what we are seeing with regards to the LEIs is that the US OECD, which is the leading indicator of the leading indicator, is actually turning up, and we're also seeing that with the LEIs. By all measures, it does look like the LEIs are starting to bottom out. We haven't got our recession, and it looks like this might actually be a false signal from the LEIs. And one thing we do have to consider is that the leading index, the LEI, was reconstructed in 2013 to account for the 2008 GFC because it didn't see the GFC in 08 coming, so it was reconstructed, and maybe that reconstruction might not account for what we're going through right now. And I do think the reason why we're probably not going to get the recession and why the LEI might be wrong has to do with government spending. Government spending has been quite robust in the last 2 years, and according to Goldman Sachs, it's probably going to continue both on a federal level and a state level. Let's read some of this right here. Now, Goldman Sachs say real estate and local government spending has recently been stronger than expected, growing at a 4.8% annualized rate in the first 3 quarters of 2023, contributing to 0.5 percentage point of overall GDP growth. We can expect sagging state and local tax revenues to moderate spending growth, and we estimate state and local spending continued growing around 4.5% last quarter, and therefore revised our 2023 Q4 GDP forecast by 0.3 percentage points to 2.1% quarter over quarter. So Goldman Sachs are now expecting GDP to come in at 2.1%. Both is actually expecting 1.5%. Let's stop talking about the public sector. Let's go on to the private sector. And something we're seeing not just in Google, but across the board in terms of companies is layoffs. Now, Google CEO says more job cuts are needed in 2024 in order to reach ambitious goals. And it's not just Google. There is a ton of other companies announcing layoffs, and we are seeing this trend coming to the market. Now, let's actually talk about layoffs. Let's dive a bit deeper into the stats to see what the labor market is telling us about the economy right now. First of all, the size and frequency of layoffs announcements have actually declined. Challenger job cuts announcements, the 3-month average versus layoff news stories in Bloomberg. And as you can see right here, that even though layoffs have come down significantly after the COVID situation, layoff announcements have actually declined, and the size and frequency of layoffs have also declined. Now, layoffs have rebounded as a result, but we're still only to the lows of 2019. So even though we are seeing more layoffs, we're actually kind of just getting to a normal point in the labor market. I mean, because this data, which is abnormally low in layoffs, has generally been an abnormality, and we are getting back to normality. Gross hiring has particularly slowed, but we're still sitting at around the 2017 pace. But we're still sitting, at the pace of hiring we were in 2017. And again, this just supports the fact of, the labor market getting back to where it was pre-COVID. Now, if we actually have a look at recent employment data, jobless claims are still low. We're going to see what they are this week. We get them on Thursday. All in all, there's nothing to stress about in the labor market right now. The layoffs that we are seeing is just the labor market getting back into its normal groove, coming off clinically low levels post-COVID. And at the same time, we're also seeing corporate sentiment improve to the 4th quarter of 2021 peak. Corporate sentiment is really moving higher. And I think the reason why we're seeing corporate sentiment improve has to do with financial conditions easing, as well as maybe they're actually seeing earnings come through and earnings improve and earnings growth in their businesses. Now, let's have a look at small business. We can't just talk about these massive companies because the small business is really the heart and soul of the economy. According to BOFA, small business is in good shape and handling hurdles. Now, small business displayed resilience in 2023 and were an important driver of overall buoyancy in the US labor market. Bank of America internal data shows monthly payroll payments per small business client rose year over year for most of 2023. And we do know that wage inflation right now is tracking at 4.1% on an annualized basis. Payroll growth, however, moderated significantly compared to the peak in March 2022. Moderation could indicate more sustainable growth going forward, as we think it primarily reflects slowing wage growth, especially in high-touch sectors like leisure and healthcare that are among the more strongly impacted by persistent labor problems during that period. Small business resilience will likely to continue to be tested 2024. BOA internal data shows December 2023 had the second lowest inflow to outflow ratio of small business check-ins and savings account across the data last 5 Decembers, highlighting pressure from small business on profits. So small businesses are hanging in there. They're in good shape. And by all accounts, this right here actually just may be seasonal adjustments. We'll have to see what the data shows us in January. Now, here is some more data points, and a majority of respondents said the overall health of their small business was somewhat good or very, very good at the end of 2023. And you can see this very poor section right here is almost non-existent in 2023, and somewhat good to very good is the two biggest averages. So this is very, very good as a whole. So we're seeing corporate sentiment, small business sentiment lift up, and that's probably because they're seeing more earnings come through in their business. And generally, the more money a business has, the happier the higher ups and the employees are. Now, let's talk about seasonality, and we keep making highs, guys. This is what generally normally returns. This is what we're doing right now, and we just keep pushing into highs in the S&P 500. We saw this massive thrust higher, like 2% in just a couple of days. Another green day for the S&P 500, and I do think this trend is going to continue. And if we actually have a look at the stats, now this is right here, the S&P 500 index performance after a first record high in at least 1 year. What other returns? 21 days, 63 days, 1 year, 6 months later, and this is what we can expect. The average return 12 months later, 14%, median at 13.4%, positive 92.9% of the time. So if we haven't had a high in a year and, essentially, we've made a significant low, we've had a rally, we make a new all-time high, we can actually normally expect returns of about 14% 1 year later. And we are, really green for this year so far. And this is also true for even 21 days later. Normally we go green and we stay green 3 months on, 6 months on, 1 year on. Now, looking at Gamma, this is the Gamma heat map. Essentially what we did in today's trade was open up, we gapped up into this area right here, made our way all the way up to 48.60, sold off, and then just traded in this area. And the reason why there was so much Gamma right here, because this was a sold iron condor, which is essentially just a long call right here, a short call right here, and then a long put right here, and then a short put right here. Essentially what this massive whale wants is priced to stay in this range, then it gets profitable. But if we did break above here or below here, we would have accelerated up in this negative Gamma situation. So just something to note right here. And I'm going to post these Gamma charts on my Twitter every single day and tell you where price is going to go, because we made a very, very good call in what price was going to do today. I said we were going to stay in this range. We did. And I gave you the exact levels, both higher and lower, on my Twitter. So go ahead and follow me on X or Twitter, whatever they're calling it right now, guys. Now, one thing we're also seeing that's supporting the bull case is the call Gamma resistance has now moved from 4,800 all the way to 4,900. But if you actually have a look at actual volumes, it's not that big because we are post OPEX. A lot of this Gamma rolled off on Friday, but we are still seeing more positive Gamma in customer positioning. And this is further backed up by dealer delta. And essentially right here, if dealer delta is negative, it means customers are in a positive delta situation. So more people are still buying calls, and we're actually seeing dealer delta get increasingly negative. And that's why we're sort of seeing this thrust right here, especially in the last couple of days in the S&P 500. Now, looking at the charts, this right here is the QQQ, the Nasdaq 100, super bullish. We broke out from here and we just keep going higher. There's actually no technical damage on this chart. And that technical damage would be if during this sell-off here, we would come and break this low. There's no technical damage on this chart. This looks incredibly bullish and has looked bullish for the last year. Now, looking at the equal weight, and the equal weight also looks very, very bullish. I do believe that 164 is all-time highs for the equal weight. And I do think that if we go ahead and break above this area right here, that's what we're going to go and do. But as long as we stay above the 153 area, I think we remain constructively bullish on the equal weight. Looking at the S&P 400 mid caps, very similar to what equal weight is doing. They did break above this high, but what needs to happen is they need to go ahead and break that high right there. But as long as we're above this 2730 level and even the 2686 level, I remain constructively bullish on mid caps. And very similar situation with small caps, although small caps need to put in more work and go ahead and take the 1314 level, all things considered. Now, this is the equal weight technology, and we had a huge gap up and super bullish as a whole. Looks exactly like the QQQ chart, although not quite as strong. I wouldn't fight the trend right here. I would buy all pullbacks, and this is actually a really good index to hold in your portfolio. You're definitely not going to be overweight some of these magnificent 7 names, but you still get extremely high quality companies and high growth companies in this index. Now, looking at, is this what? Healthcare looks very strong, very strong. I mean, we said that we're going to remain bullish as long as we're above this level right here. We bounced right off the 138 level, and really healthcare needs to go take this high, then take this high, and then look for 144. Looking at Nvidia, and this just keeps going higher towards the 600 area, and this looks very bullish. I wouldn't short Nvidia at all. If you really want to look for shorts, it's below the 400 level. Other than that, buy all dips. And especially, let's say we do retrace to the 500 area. That's going to be a very good level to get into Nvidia. But I don't think we get there. I think we just keep trugging along higher. Maybe we build out like a base of support around here as we head into earnings. But all things considered, Nvidia looks very strong. And here's something I want to make you guys aware of. This is kind of crazy. Nvidia Corp and Microsoft Corporation, just 2 companies in the S&P 500, make up 57% of the total gains year to date. And then Meta, AMD, and Eli Lilly come in very close to 20% of total gains for the year. So just these 5 companies right here making up very close to 70 to 80% of total gains in the S&P 500. Now, looking at Microsoft, look at how bullish this looks. This looks very bullish. This was such a bullish setup that I alerted you guys on, a good couple of weeks ago now, and we've broken out from here, and I think very similar to what we're going to see with Nvidia. Maybe we just consolidate here, but if we do go higher, I wouldn't be surprised. Looking at financials, this looks very bullish. I mean, this looks like the healthcare chart, except we've broken above the highs right here. And what financials need to do now is try and get a weekly close above the 38-32 level, and then go and try attack the $40 region. Very bullish on financials right now, and still very cheap, trading at a 13 PE, all things considered. Now, looking at PayPal, I did a ton of analysis on PayPal in yesterday's video. You guys should go check that out, as well as put on a ton of stuff on my Twitter about PayPal. By the way, I don't hold a position in PayPal yet. I'm waiting for earnings, but all in all, we bounced right off the moving average, the 200 moving average right here. And as long as we stay above this line, I would remain bullish to go ahead and break these highs in PayPal. It was up like 3% in pre-market, so I think a lot of people got in pre-market and then got rugged. The weak hands are gone from holding this company right now, from holding the stock. And I based on like what we're seeing right now, as long as we stay above here, we're just going to continue higher, in my personal opinion. Looking at TLT, we're approaching the moving average right here. We've bounced off it. What TLT needs to do is just get above it and continue to consolidate. But we'll see if this is going to move higher, especially if rates move lower, or if we're going to get a situation like here where we just trend along the 200 moving average. Now looking at data in the week ahead, data really kicks off along with earnings, guys. So we get GDP, I believe, tomorrow. We also get personal consumption, core PCE, durable goods on the 25th. We also get new home sales as well as wholesale inventories. And then on the 26th, this is when we get PCE. And here are the expectations for PCE. So BOFA forecasts we're going to do about just at 0.1% in PCE. The market is pricing in a negative figure for PCE. So BOFA a little bit more bullish on what CPI is going to bring to the table. They think a hot CPI figure. Now, looking at GDP forecast, Goldman Sachs forecast 2.1% quarter over quarter. By the way, BOFA's forecast is 1.5% quarter over quarter. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe. Guys, hit that notification bell, like this video, leave a comment. Cheers.